Hey everybody, in this video I'm going to go through the PowerPoints that go with the book. So if you haven't already, what I would like for you to do is print off that reading guide that goes with your chapter, because it's going to be a great way to outline the chapter as you watch these videos and as you read through the chapter for yourself. And of course, with an accounting book, what you're going to do is as you read through the book, anytime there's a problem, you'll stop and work it out as you go to make sure you understand where the numbers come from. And that's going to help you understand the chapter content, okay? So on these PowerPoint videos, I kind of go back and forth whether or not they're needed, but I always have students tell me they appreciate this part of the online class. And so I'm going to walk through the PowerPoints, and I don't want to read them to you, so you still need to read the chapter. And I've also uploaded these so that you can print them out if you like to look at those. But let's get started, and I've divided this chapter into two parts just to break it down so it won't be quite so long for you to watch in one sitting. So here we go with the PowerPoint slides for Chapter 10. Chapter 10 is about fixed assets, also called plant assets. Those are your long-term assets. We're also going to discuss natural resources and intangible assets. Here are the learning objectives here that we'll cover in the chapter. The first thing we're going to talk about is how to measure the cost of property, plant, and equipment. That's the cost of those fixed assets. Number 2 is a big portion of the chapter, and hopefully you've already watched my lecture video on depreciation, where I talk about how to calculate depreciation using these 3 methods. Then number 3, the journal entries to dispose of a plant asset. And then we're going to account for natural resources and intangible assets. Now, learning objective 6 is going to teach you about the ratios. Now, for that part of the chapter, I want you to read the chapter. You're going to have a homework problem about ratios, but I will not test you on ratios. Chapter 17 is totally devoted to you learning the ratios, and so I will not test you on the ratios until we get to Chapter 17. And we will not go through appendix for Chapter 10, so learning objective 7 does not apply to you. All right, so let's get started on measuring the cost of a fixed asset. Now, fixed assets can be called property, plant, and equipment. You'll see that on a balance sheet. PPE stands for property, plant, and equipment. And these are long-lived, long-term assets. And most of these will depreciate. Matter of fact, all of these will depreciate except for land. But our examples of long-term assets here are land, buildings, and equipment. Depreciation is when you allocate the cost of a long-term asset over the asset's useful life. And this is following the matching principle. The cost of using up an asset is matched against the revenue that is earned during that time that it was used. And here you see the life cycle of a plant asset or a fixed asset. You acquire the asset, so there'll be a journal entry to acquire the asset. And then every year there's going to be a journal entry for depreciation that's going to record the usage of that asset. And a good definition to write down for depreciation is depreciation represents the decline in usefulness of a fixed asset. And then at the end of the life of the asset, you will dispose of the asset or you will sell the asset, and another journal entry will be needed to remove this car or this vehicle from your books. Plant assets are always recorded at historical cost. What did it cost you? And that is according to the cost principle. Now I want you to read this part where it says the actual cost is the cost of any fees you pay plus any amount paid to get the asset ready for use. So we'll look through a couple of examples here. This next illustration shows you the cost of purchasing land. So for the land account, these costs would be rolled into the cost of the land. These costs would be called land improvements. Now, Land, as I told you, never depreciates. However, the asset account called land improvements will depreciate. Now, when you look at the cost here, these are all costs having to do with the actual land, including clearing the land. But when you look at land improvements, you'll see that these are things that we did on top of the land, like we paved a road or a sidewalk, fencing, lighting. All that is land improvements. So now you'll see an example that would look like maybe one of your homework problems where several costs are listed and you have to come up with the total cost of the land. And here all of those costs are included to be $62,000. Now it tells you here that we purchased the land for a notes payable and then we pay the other cost. So here's what that journal entry would look like. Land is debited for $62,000. You credit the notes payable for $50,000 and credit cash for the other $12,000 that was paid. All the costs are included in land, which is it's called capitalizing that cost. Capitalized means that the asset was debited because we acquired that asset. So when you capitalize a cost, that means it's an asset. Land improvements here are recorded in an asset account called land improvements, and credit cash because we paid cash for those. And notice here that land improvements are depreciated. Cost of the building, this chart's just going to help you know when to, what fees to include in constructing a building or purchasing an existing building. I want you to read through these in the chapter. Then it's going to go through the cost of machinery and equipment, cost of furniture and fixtures. And then you get to the point where it's talking about a lump sum purchase. Now, this is a problem, a mathematical problem that you will have to do on the test and on homework. So I'll show you how to do it here. But if you have a basket purchase of goods, meaning you purchase more than one item at a time, then you've got one price but two assets. And so you've got to figure out the cost or allocate the cost to those assets. And we're going to use a method called the relative market value method. So let's see how that works. We paid $100,000 for land and a building. So we've got to figure out what part of that $100,000 is allocated to the cost of the land and what part of the $100,000 is allocated to the cost of the building. So what we do is we look at the fair market values. An appraisal indicates that land is worth $30,000. The building's market value is $90,000. So the step one here is you will add up the market value of the land and the building, and that's $120,000. Then you're going to figure out the percentage of total value for each, the land and the building. So you see here that $30,000 divided by 120 is 25%. So out of that $120,000, land represents 25% of that value, and the building represents 75% of that value. So the next thing you're going to do is compare that with the $100,000 purchase price. So this is just another way, same math, just a different way to lay it out. But you've got the market value here of the land divided by the total market value is 25%. Take that 25% times 100,000, and we're going to assign $25,000 cost to the land, and 75% times 100,000 is 75,000 that we will assign to the cost of the building. Remember, the total amount paid is 100,000. So this is what the journal entry would look like. You would debit land for 25, building for 75, and credit your notes payable liability account for 100,000. Capital expenditures versus revenue expenditures. This is pretty easy to get. I just want you to know that a revenue expenditure is just a normal expense, just like you learned in Accounting 1. Capital expenditures is when you add value to an asset and you actually roll the cost of that capital expenditure into the asset instead of treating it like a normal expense. And you'll see here that capital expenditures also include what we call extraordinary repairs. Those are repairs that don't happen very often, but they do extend the asset's useful life. So let's look at an example here. We spent $3,000 to rebuild an engine. Well, that's going to extend the asset's life. So instead of debiting expense, we actually debit the truck account, the asset account for $3,000. That's because we're going to capitalize that expense. We're going to call it an asset because it increases the life of our asset. These are normally large expenses, and they're going to tell you in the problem that it's going to extend the normal life of the asset. And then you credit cash because you paid cash for that. Our next slide shows you that we paid $500 to replace the tires. Well, that's a normal expense of owning a truck, so you would just debit repairs and maintenance expense and credit cash for $500. This is a good chart, Exhibit 10.3, just to help you show which expense or how these expenses would be assigned. Okay, learning objective 2, accounting for depreciation using straight line units of production and double declining methods. Now, I hope you've already watched the video where I work these out because I'm going to go through these slides very quickly. First of all, what is depreciation? How is it computed? It's going to match. We talked about that. It goes along with the matching principle. All the assets except for land wear out as they are used. So everything, all of our fixed assets except for land, will depreciate. In order to calculate depreciation, you need to know the cost of the asset, the useful life, and the residual value or the salvage value of the asset. These will all be given to you in the problem. The first formula you need to memorize is the depreciable cost. Depreciable cost is how much depreciation is allowed on a particular asset. And the depreciable cost is cost minus residual value or salvage value. Let's look at this. These are the facts for the problem we're going to work through. The most commonly used depreciation methods are the three that we're going to use in this chapter: straight line, units of production, and double declining balance, or you will hear me call this DDB. So, for all three problems, here are our facts. The cost of the truck is $41,000. The residual value or salvage value is $1,000. That means that the depreciable cost is $40,000. The estimated useful life is 5 years, or the estimated useful life in units is 100,000 miles. Now, for straight line, we're going to use years, and for units of production, we'll use miles. I'll show you how this works. For a straight line, what we'll do, and you may want to write down this formula, it's going to be the cost minus the salvage value divided by the useful life or the number of years. So 41,000 minus 1,000 is 40,000 divided by 5 equals $8,000 per year. And as you know from Accounting 1, the journal entry for depreciation is always the same. It's debit depreciation expense dash whatever asset is depreciated, and then you credit accumulated depreciation dash the asset. So here we debit depreciation expense for $8,000, credit accumulated depreciation for $8,000. This is straight line. On the balance sheet, you will always see the book value of an asset. So you'll have the asset account truck recorded at cost, less any accumulated depreciation for that asset. That is a contra asset account. So you subtract it out to come up with the book value of the asset. If you own this asset for 5 years, accumulated depreciation will get bigger each year, and the book value will get smaller each year. So here's another chart to show you straight line depreciation. You see here that it's $8,000 each year, and at the end of 5 years, the book value is actually the same as the salvage value. Next, we're going to look at units of production, and it's going to work almost exactly the same way as straight line. First of all, you see that we expect this truck over the next 5 years to be good for a total of 100,000 miles. So the first thing you're going to do is you're going to figure out the depreciation per unit. That's going to be cost minus residual value. 41,000 minus 1,000 is 40,000 divided by miles instead of years. So you divide it by 100,000 to come up with 40 cents per mile. This is depreciation per unit, or you could even call it the depreciation rate, 40 cents per mile. The rest of it is easy. Once you figure out the depreciation rate per mile, then you see up here that it says in year 1 we drove the truck 20,000 miles. Well, we'll take 20,000 times 40 cents to come up with 8,000 per year. Let's look at the chart. Year 1, we drove the truck 20,000 miles times 40 cents. 8,000 is depreciation expense. It's just a coincidence that that's the same as straight line. That is not usually the case. Then our book value would be the cost in year 1 minus accumulated depreciation, 33,000. In year 2, we drove the truck 30,000 miles times 40 cents. We get to depreciate $12,000 this year of depreciation expense. That would bring accumulated depreciation up to 20,000. Then our book value is 21,000. It's the cost, 41,000, minus our balance in accumulated depreciation of 20,000 gives us 21,000. So as you see, the book value goes down each year. The last method is called double declining balance. It is an accelerated method, meaning that more depreciation expense happens up front. Okay, these are my notes here, not from the book. I've added this slide, so you may need to write this down. Go ahead and pause if you need to get a pencil to write this down. Step 1, calculate the straight line rate. That is going to be 1 divided by the number of years. In our example, the truck is good for 5 years. So straight line rate is 1 divided by 5, which equals 20%. Step 2, calculate the DDB, double declining balance rate. That's going to be the straight line rate times 2. You're going to double that rate. So step 1, we decided straight line rate was 20%. We're going to double that, 20% times 2. 40% is the DDB rate. Step number 3, to figure out depreciation for each year, you'll multiply the book value of the asset at the beginning of the year times the DDB rate. The DDB rate stays the same. So at the beginning of year 1, the book value is 41,000 times 40%. So 16,400 will be our depreciation expense for year 1. This is a little bit more than double the straight line rate, if you remember. 2 notes. DDB does not use salvage value until the very last year. Remember that the book value changes every year. Let's look at this example. This is our truck that cost $41,000. Now you see here in the book, you'll see the way that they determine DDB rate is 2 times 1 divided by 5. That's 40%, guys, okay? I think it's easier to see 40% than to see this calculation every year. 41,000 times 40%, 16,400. Book value, 24,600. Next year, year 2, you'll multiply 24,600 times 40% to get $9,840 worth of depreciation expense. Accumulated depreciation then grows to 26,240. Your book value is now 14,760. 14,760, which is the book value at the beginning of year 3, times 40% is 5,904. Brings your accumulated depreciation up to 32,144, and your book value is 8,856. The next year, 8,856 divided by 40%, multiplied by 40% is 3542 is your depreciation expense. Accumulated depreciation then is 35,686. In year 5, you won't use DDB, but rather you'll plug this number so that depreciation expense will grow accumulated depreciation to be the total depreciable cost, so that the salvage value will be, the book value will equal the salvage value. So hopefully this makes sense, but as you work through it, you'll see. But I like to plug 40% in instead of writing out this formula every time. Notice when you compare depreciation methods that in each one of these methods we recorded 40,000 total of depreciation expense. Why? Because that is the amount of depreciation allowed. This is graphing, and you see here straight line is this blue line right here. That means that $8,000 was recorded for 5 years. So if you graph it, it's a straight line. Red is units of production. You can see here that in year 2, we drove the truck more than year 1. And this, because it's directly affected, that depreciation is directly affected by the amount of time or miles that we use the truck. Now look at DDB. Remember, it's the accelerated method, so you claim much more depreciation in year 1 than in year 5. Depreciation for tax purposes is MACRS, M-A-C-R-S. It's called a Modified Accelerated Cost Recovery System. Yes, you will have to compute depreciation differently for taxes than you will for GAAP. Where is that? Sorry, I messed up the slides there. Okay, so just know MACRS is the modified version used for taxes. Partial year depreciation. The things that we've looked at so far has been for a whole year, the depreciation expense for a whole year. What you would do is you would prorate that. If it's for 6 months, you would divide that depreciation amount. You would say times 6/12 or just divide it by 2, okay? And so you want to look at the dates if the question is about partial year depreciation. Here's an example. Assume that a truck costing $41,000 was placed into service July 1st. It had a $1,000 residual value and a 5-year life. And so what we would do here is you would calculate the straight line amount, which would be $8,000, and then times 1/2, because you've only owned it for half a year, is $4,000. So just pay attention to the dates if it's that type of a question. Changing estimates. Sometimes after we put an asset into use, we realize maybe it has a longer or a shorter estimated useful life, and so sometimes those estimates change. These problems have to do with that. And so you have to understand the depreciation methods and how to calculate depreciation and book value first before you can tackle these questions, okay? Notice that prior years are not restated. You don't go back and change journal entries. What you do is if you have a new estimate, you just change the current year and future years. Changing estimates of a depreciable asset. Smart Touch Learning used the truck purchased on January 1st for 2 full years. That truck cost $41,000, had a $1,000 residual value, and a 5-year life. So as you remember, we depreciated it for $8,000 per year. And it says we've depreciated it for 2 full years. So we say 8,000 times 2, 16,000 is the balance of our accumulated depreciation account. So we're at the end of year 2. And then what they're going to tell us is the remaining depreciable book value costs less accumulated depreciation is $25,000. So what we've got is our book value is $41,000 minus $16,000 is $25,000. Then they tell us we believe that the truck will remain useful for 6 more years, meaning we have a total of 8 years, not just 5 years. Residual value is unchanged. At the start of 2021, we're going to recompute depreciation. So the way we do this is we'll say $25,000, that's our book value right now at the beginning of year 3, minus $1,000 divided by 6 more years, because this is the number of years remaining. And that gives us $4,000 per year is our amount of depreciation we can charge on this for the next 6 years. And here's our journal entry: debit depreciation expense, credit accumulated depreciation for $4,000, and we'll make this entry for the next 6 years. Reporting property, plant, and equipment. Remember that you're going to be able to find the book value on the balance sheet. So here is an example of the fixed asset portion of the balance sheet. Notice here the title is Property, Plant, and Equipment, Land, and then you have your building, less accumulated depreciation for building, and then there's a subtotal right here, which represents the book value. And then you have furniture, less accumulated depreciation for furniture. And once again, over here on the right, you have another subtotal. That is the book value of the furniture. And then you total up these three numbers to get total property, plant, and equipment. In a balance sheet, you would also have current assets above this, and total assets would be totaled at the bottom. Another way you could show this on the balance sheet is you could just have a one line item for plant assets, and that would just be $97,450, which is the net number you see here, that total number. So it could just be shown, like if your financials are huge, you would just consolidate that all together and just call it plant assets. This ends chapter 10, part 1. In part 2, we're going to discuss how to sell a fixed asset, dispose of a fixed asset, natural resources, and intangible assets.